All right, let's talk about what's shaping up to be the biggest market event in a decade, the Big Kahuna IPO Wave. We're talking about giants like OpenAI and SpaceX finally heading for the public markets. Today, we're going to break down exactly how they're being priced and, more importantly, what it really means for you.
And let's just start with this quote right here because it gets straight to the point. It's the core idea of this whole explainer. The real generational wealth from these companies, it isn't being made on IPO day. Nope, it's being made right now behind the scenes in the private markets.
So, you might be asking, why now? What's the big rush? Well, the starting gun has just been fired. Blackstone, a firm that manages over $1 trillion, just declared that the IPO window for these AI giants is officially open. So what we're going to do today is unpack that signal, see what it means for SpaceX and OpenAI, figure out how the pros get access before anyone else, and uncover the brutal truth about who really makes money when a company goes public.
Okay, so let's dig into that signal first. You have to understand, this is not just some simple market recovery. What we're witnessing is a fundamental repricing of the most powerful private companies in the world, and it's all being driven by something much, much bigger, an infrastructure-led supercycle. You know, when Blackstone talks, Wall Street listens, and with $1.3 trillion in assets, their word is basically gospel. So when Jonathan Gray comes out and says this, he's not just being optimistic. He's signaling that there is a massive pipeline of AI infrastructure companies that are ready to go public. This is the catalyst. It's what connects the insane valuations of these companies to their ability to provide the raw power, the data centers, the compute that this whole AI revolution desperately needs.
All right, so that brings us to the main event, right? Pricing these behemoths. We're going to look at the big three, that's SpaceX, OpenAI, and a really interesting dark horse, Anthropic. We're going to dive deep into how the big institutions are actually valuing them right now, long before they ever hit a public stock exchange.
First up, SpaceX. And wow, these numbers they're just staggering. A target valuation closing in on $1.75 trillion. But the really crucial part here is the why. See, after merging with xAI, SpaceX isn't just a rocket company anymore. It's being valued as a sovereign AI play. Think about it. It's an infrastructure provider with plans for orbital data centers. We're talking about data centers literally floating in space, immune to regulations on Earth. That's the strategic moat. That's why it's commanding a valuation of almost 100 times its revenue. It's a whole new ballgame.
Okay, next up, OpenAI, probably the most famous name in AI. But this is where we run into the brand paradox. While everyone knows their name, the actual business metrics, well, they're making sophisticated investors pretty nervous. And here's the brutal truth. Its capital efficiency has totally tanked. For every dollar it raises, it's making less and less revenue. I mean, look at that projected net loss. Losing $14 billion on $25 billion in revenue? That is an insane burn rate, and it's being propped up almost entirely by Microsoft.
And this slide right here, this shows what we call the quality inversion that's happening in the private markets. While OpenAI is out there chasing consumers, and remember, 85% of its users pay nothing, Anthropic is quietly behind the scenes locking in these super valuable, super sticky enterprise contracts. So as OpenAI's efficiency is just cratering, Anthropic's recurring revenue is exploding. This is what the institutional money is looking for. A real, profitable business model.
I mean, seriously, the numbers for Anthropic are just wild. Its valuation on the secondary markets has skyrocketed to an implied $1 trillion. It more than doubled in just a few months. The driver behind all of this is a breakout product called Claude Code, an AI coding assistant that big companies are adopting at a crazy pace. And that's why it has become the institutional darling of 2026, hands down.
So here it is, the punchline. This table lays it all out. The expected POP, or the premium from the last private valuation to the target IPO price. For SpaceX and OpenAI, you can see that most of the value has already been baked in. The expected premium is less than 20%. But then, look at Anthropic. The potential upside is somewhere between 58% and a whopping 110%. This is the math. This is exactly why the smart money is chasing Anthropic in the private markets. The chance for a huge repricing at its IPO is still very much on the table.
Which, of course, brings us to the most practical question of all. If the really big gains are happening before the IPO, well, how do you get in on that? This next section is all about that pre-IPO gold rush and where the real value is actually being made before these companies ever see a public trading screen.
So where is that 90% upside we keep talking about? Look, it's not a secret, but it is an exclusive world.
It's found in what are called the secondary markets. These are the platforms where shares of private companies are bought and sold long before an IPO is ever announced.
Now, getting into this market has traditionally been a three-step dance. First, you have to be an accredited investor, which basically means you have a high income or over $1 million in net worth. Second, you use these specialized platforms like Forge Global or EquityZen to find employees or early investors who are willing to sell their shares. And finally, you actually do the trade, which can get complicated. You have to navigate things like the company's right of first refusal, which gives them the option to buy back the shares first.
But here's the thing, and this is a massive shift that's happening right now. This once super exclusive market is starting to retailize. Charles Schwab buying Forge Global, that's a complete game changer. It could give 38 million brokerage accounts exposure to private stocks. And at the same time, new SEC rules are making it easier for big funds, even your 401k, to invest in these private companies. The doors are definitely starting to creak open.
But okay, before you get too excited and start looking this stuff up, there's a really critical piece of the puzzle that almost everyone misses. You gotta understand, investing in private shares is not like buying Apple stock. You have to understand the hidden term sheet, because that document is what decides who gets paid first if things don't go perfectly to plan.
Okay, the single most important concept here is liquidation preference. The easiest way to think about it is like a payment waterfall. When a company gets sold or goes public, the money flows down from the top. And liquidation preferences are just clauses in a contract that puts certain investors at the very top of that waterfall. It ensures they get their money back, and usually a lot more, before anyone else sees a dime.
Let me just give you a number to hang on to really anchor this concept. 2x. It might not sound like a lot, but in the world of venture capital, that little term can mean the difference between a massive win for one investor and a total wipeout for everyone else. And here's what that 2x means in the real world. If a big VC fund invests $100 million with a 2x preference, they are contractually guaranteed to get $200 million back from an IPO or a sale before the founders, the employees, and other common shareholders see a single dollar. It is a massive risk that's buried deep in the legal documents.
Yeah, the key takeaway here is that not all shares are created equal, not even close. Under the most common structure, standard seniority, the last people to invest are the first to get paid. So if you go out and buy common shares on a secondary market, guess what? You are at the absolute bottom of that payment waterfall. And if the company has what's called a down round IPO, meaning it goes public for less than its last private valuation, these preferences can and often do wipe out 100% of your investment. And that brings us to our final section, and my personal favorite theme, the brutal truth. We are now going to bust the biggest myth about IPOs. That celebrated day one pop.
We've all seen the headlines, right? Some hot new tech company goes public. The stock soars 30, 50, maybe even 100% on the very first day. It looks like free money. It feels exciting. But what the data shows consistently and brutally is that buying into that day one hype is often the worst possible entry point if you actually plan to hold on to the stock.
The data here is, well, it's pretty damning. The average first-day IPO return is a fantastic 23.6%. But that gain? It's captured almost entirely by the big institutions who get shares before the public. Retail investors are buying after the pop. And if you hold that stock for 3 years, the average IPO has historically underperformed the market by a staggering 21.6%. It's a total performance illusion.
So what is the IPO pop actually for? It's a mechanism. Its main job is to provide exit liquidity. All that hype, all that media attention on day one, it creates a flood of demand from everyday retail buyers. And that demand is what allows the early venture capital investors, the ones who got in years and years ago, to finally sell their shares and cash out at a fantastic price. In a lot of cases, it's the retail frenzy that is the VC's exit strategy. So this brings us right to the final question. This Big Kahuna Wave is coming. It's going to be one of the most significant reallocations of capital in a decade. The data is crystal clear on how these things usually play out. So the choice is really yours. Are you going to be the one buying into the day one hype, providing the exit liquidity for somebody else? Or are you going to understand the mechanics and find the real alpha before that opening bell ever even rings?